the Karnataka Digital Economy Mission and the Karnataka Startup Cell, the government of Karnataka, KTEC, and all the various partners have all come together and combined to put together this very interesting session where investors will be covering some very critical elements that will be of high value to the founders and startups. We want to make sure that this is as participative and useful as possible. And what matters here is that you all benefit, you all gain. So please, all of you all have got the Zoom link. Please share it out to your community because we want more people to come in, interact, network, and basically grow, because that's what Karnataka and Bangalore is all about. So with this, we just set a few elements on that we have three fantastic and really versatile and experienced speakers today. But more than just being experienced or speakers, they're the people who really care. They want to give you a lot of knowledge. So please take advantage of the fact that after they finish the presentations as a Q&A, you can keep posting the chat on the chat. Vinay and me are here, and a few of our other people are here, interns and volunteers. We'll make sure that we'll try our best to get as much communication as possible going to you. So with that, we're keeping it very, very brief. So Srinivas, this is over to you. And, would happy to have you speak for a quick 1 minute and tell us a little bit more about yourself and your venture itself also, that Rule Zero. And that will be the same for Shri Krishna and Ragini as well, because we want you to talk about yourself. And with this, over to you, Srinivas. Thank you so much once again for taking the time out. We really appreciate this, and warm gratitude to you.
Good afternoon, everybody. I'm a lawyer by training. Was part of the one of the founding members of this law firm called Indus Law, which is fairly active in the startup ecosystem. We started the firm in 2000. Sometime in 2019. Me and my co-founder Satish started this company called Rule Zero. Rule Zero is incubated by Indus Law, so I still continue to be there. What Rule Zero does is automate the entire processes around share issuances, share transfer, ESOPs, ESOP management, ESOP secondaries, ESOP buybacks. The long-term vision is to build a private exchange. In phase one, what we've done is automated the entire process around share issues and share transfers. We are in the process of automating the ESOP plan generation. What I mean by that is, the market standard today is a service provider will give you an ESOP plan and ask you to consult with a law firm if you want to change it. Whereas what we are doing is the system will ask you a bunch of questions. Based on your answers, an ESOP plan is generated by the system itself without any human intervention. ESOP administration has already been automated by us. Grants, exercise, tracking, vesting, dashboards for individual employees, all that is done. So that's a very brief introduction to Rule Zero. A longer introduction or a longer chat I can always provide as needed.
Thank you. Thank you so much, Srinivas.
I've been asked to speak about readiness for fundraising. So I'm just going to share my screen first. So what I've tried to do here is what we've tried to do here at is to just include some high-level pointers. In 30 minutes, it's virtually impossible to discuss every possible thing that arises with reference to financing. So these are the key elements. Just put this together: cap tables, key contracts, due diligence readiness, founders agreements, compliance and registrations, IP ownership, FDI compliance of the business model, and accounts and finance. These are the broad elements that you need to work through. It's not something you can do a week before fundraising or 2 weeks before fundraising. This is an ongoing process and you need to get it right. So it's important that as founders, you spend time on it. When you don't spend the appropriate amount of time at the initial stages, the risk you run into is delaying your financing. And in some cases, we've also seen that companies need to be reincorporated, and you need to transfer the entire business over to a new company that you guys set up. So it can take 6 to 9 months to sort out some of these issues. If you don't get it right. Therefore, it's important that you spend time on these elements at a very early stage and watch them on an ongoing basis. As far as the cap table is concerned, carefully freeze the allocation between the founders and other stakeholders. Oftentimes, we've noticed that there's an agreement between the founders on their inter se shareholding, but actual issuance or transfer wouldn't have taken place. Shares are held by one founder or some aunt or uncle, or the actual allocation is not represented on the cap table. Completing the issuance and transfer is important, because if you delay it, there are all kinds of tax complications to deal with, especially if it's pretty close to a fundraising round. There is a legal requirement of issue and transfer of shares being at fair value. Of course, in the case of equity, that is book value itself, but even book value can be high at times. And if it gets very close to a financing round, you are unnecessarily taking tax risks. Determine your allocation for key management. There's no need to issue the shares to the key management. There's no need to complete the grants and stuff like that in an early stage. You should have a sense of how much you want to allocate, and that should go into your calculations very quickly. And complete your issuance and as I mentioned earlier, complete the issuance and transfers. The other aspect of that same issue is that make sure that your filings with the regulator, whether it is RBI or ROC, are extremely accurate. Cap tables cannot have 99.99% accuracy. Anything below 100% is a problem. It can create issues when you want to do an M&A, you want to do filings. Regulators take even minor issues with reference to cap tables very seriously. You could end up violating deposit regulations. You could end up violating FEMA regulations. So make sure that there's 100% accuracy as far as your cap table is concerned. This is key compliance, key contracts, and registrations. Basically just do a sanity check. Any good chartered accountant will help you with this. Make sure you get all your labor and tax registrations, your business registrations. If your offering is global, make sure that export registrations that are required are in place, exporter importer number and stuff like that. Make sure you get your startup registration. This is often neglected. It's a pretty valuable registration because it gives you cover against a whole bunch of tax issues that come up. Very often when you're issuing shares and you have a resident and a non-resident investor putting in money at the same price, there are some unintended tax consequences that flow. If you have a startup registration, you don't have an issue. Now, the startup registration is in two parts. One is the basic startup registration with the Department of Company Affairs. The other one is a tax registration, which is a consequence of the first one. So make sure they are both in place. One thing we often find missing is posh policy and officers in place. These are serious issues which have huge social ramifications, legal ramifications, potential criminal prosecutions. And, while some of these things you can deal with, one thing you cannot is, the backlash that arises from enterprises and customers if you don't have a posh policy in place. Check for business specific registrations, depending on what is your area of business. For instance, a manufacturer of pharmaceuticals needs to get registrations, to manufacture those specific formulations. Key contracts, ideally get a law firm to review it. If it's too expensive, get a good chartered accountant to review it. I'm only talking about key contracts here. The main business contracts that you have, stuff like employment contracts and IP ownership contracts with employees are all templates. I don't view them as key contracts here. Here, the key contracts are really large business contracts that you have, from key customers. Make sure that your data and IP ownership provisions, penalty provisions, hiring restrictions, your no hire, non-solicit and non-competes are clean and acceptable to you from a long-term perspective. These with enterprises, you cannot go and renegotiate some of these terms and they can come back and hurt. IP is a very key and important aspect, both intellectual property and data. I've just clubbed them together here, though they should not be, just so that we can get through this very, very quickly. Patent registration is super important. If you don't file on time, you cannot apply for a patent. Even if it's expensive, you'll have to find the funds to do it. If you don't register for a patent that you need, it damages your business prospects on the long run. Make sure that your trademark registration and domain registrations are the name of the company. Oftentimes you find that they're registered in the founder's name for convenience because you're going to apply for them before the company is formed. Immediately after the company is formed, transfer it. Important contracts from an IP perspective, these are IP contracts are, employee IP, what you call the innovation agreements. All your vendor contracts should have the necessary IP ownership provisions in place. and appropriate rights for the company under license contracts where you're in, where there's any inbound license. The last thing is privacy policy and data. This is a very, very important aspect, especially if you're a global business. Make sure that you are in compliance with global data protection laws. Data protection laws, can stop you from doing business. It may be expensive in some countries, but you don't have a choice. The regulator will just come and shut down your business or impose significant penalties if you're not in compliance of these. This one is a very ignored provision. To me, it sets the tone for how your shareholder agreement with the investors go. The 4-5 key elements are what are the roles and responsibilities of each founder, document them. This should be the big picture responsibility, not like in an employment contract. There must be commitment to employment with the company for the long term for every founder. The exception being, obviously some founders who are serial entrepreneurs or very, very senior executives who are supporting a company. But for everybody else, the employment contract should be in place. Have a clear understanding of what happens if an employee resigns. Sorry, if a founder resigns or a founder is not able to get along with the other founders or there is cause. You'll see founder vesting clauses very commonly in financing documents coming from investors. Don't view this as something which the investors are putting in place for their benefit. A founder vesting provision benefits the continuing founders as much as they benefit a new investor who's coming in. So it's important that you recognize that if a founder leaves and takes that stock that he has with him, and you need to replace that founder, a whole bunch of new options need to be created, and that's dilutive for everybody, including the continuing founders and the investors. We've seen this as a bigger issue when you have more than two founders. Or, when there are two founders, usually this doesn't become such a big issue, but very often when you have 3 or 4 founders, one founder ends up leaving. And 6 months, 1 year into the business, if he leaves and he's holding whatever 10 to 20, 30% of the stock, that's a serious issue. Agree on transfer restrictions like lock-ins, ROFRs, non-compete obligations for each founder. That should be fairly basic. Figure out your board structure and questions like who your CEO is, and make sure that you have appropriate powers vested in the CEO. Investors like to see clarity in the relationship between the founders, and they will always back the CEO. If it looks like there is community of ownership and decision making at every level, that's not something which investors like to see. The next one is FDI compliances. FDI compliances can be in 2 parts. One part is basically around whether your business can receive FDI or foreign direct investment without any approvals. The second category is where approvals are needed. Be sure which category you fall into. And if you're in the second category, at the point when you need to get money, you need to be sure that the business model conforms to what the regulator likes to see, before they permit the investment. The other thing is, oftentimes we find that companies say that today we don't have foreign money, therefore we don't worry about this. The truth is, if you end up building a business model that is not capable of receiving FDI, and you have to rejig the business at the point when you're getting FDI in, it's a huge complication to deal with. There'll be substantial delays in financing, and it could also affect your business model because you've already built a structure around the model that you have developed. The last thing on this aspect is consistency. What I mean by consistency is, mota your big picture business model will be clear, but your contracts are not consistent with that. Your policies are not consistent with that. One example I can give is, FDI in financial services businesses or fintech companies that are not regulated by a regulator require FDI approval. So, if for instance, if I'm a banking correspondent, or if I'm a platform that is distributing retail loans, a lot of firms take the view that you don't need any FDI approval for getting money in from foreign investors. But if your business contracts, the contracts that you sign with banks, sign with the NBFC, sign with other lenders, establish some degree of control over that lending that is being done on the balance sheet of the lender. Effectively, you are a financial services provider. Now, big picture, you are saying that you're not regulated, I mean, you're not a financial services player because you're lending out the balance sheet of a regulated entity, but operationally you are taking financial decisions for them, and that is a strict no-no. Getting these contracts renegotiated with banks is a huge complication. Therefore, make sure that you have consistency between your contract, your policy, your procedures, and your business model. The last thing is, accounts and finances. This most people are careful with. The only thing we see is often expenses are maintained on Excel, in other loose forms. Make sure that you use technology like Tally or QuickBooks or whatever it is, and make sure that you're cross-checking stuff so that when an investor wants to come in, diligence can be quickly done. Make sure that you're tax compliant. Tax compliant. One thing which is seriously checked by investors is tax, and one thing which regulators are very, very conscious about and check with companies is tax. Make sure that your TDS and GST processes are in place, and your categorizations, classifications are correct. Don't take risky views in these things. They always come back to bite. So, quickly about Rule Zero. This is what we do, what I explained in the beginning. Happy to take questions now.
Great, a lot of insights in short time frame. A couple of questions are there. One was, this presentation will be shared with the attendees, right? Is it okay to share this?
Oh, no problem at all.
Okay. And there's a question from Himanshu on how do we show tech ownership? I'm not sure what he means by that, but it's probably the co-founders agreement or...
No, tech ownership, there can be two parts. One is, tech is really software, right? If you have a formulation, you'll go and get a patent for it. But a lot of times it's just software. With software and software tech, it is only copyright benefit that you can get largely in India. Globally, sometimes, I'm not an IP lawyer, but in some situations, you can get a patent in the US. If it's patentable, you get a patent. Otherwise, you make sure that you have processes in place to ensure that there's no copying. It's all original. And your employment contracts and your vendor contracts have appropriate provisions vesting the ownership of the tech in the company. That's all you need to do.
Okay, great. So do you have more questions? I see, Himanshu, you can type in your question. We see there's a question from Kanchan as well. Should you have ESOPs pool before investors come in?
Can you say that again, Vijeta? Can you have ESOPs?
Yeah, should you have an ESOPs pool before investors come in? So should you, allocate a percentage for your team members as well before you start talking to investors?
Ideally, yes, because employees would like to see a pool created, but it's not mandatory, so to speak. A lot of companies create the ESOP pools only post financing not actually taking place, because a valuation gets established. Without a valuation being established, when you make grants, it becomes a little disorganized, and you end up giving much more than you have to offer. You'll end up saying, I'll give X percentage of the company, Y percentage of the company. That is never good. It's always better to specify a number of shares. Therefore, the most common practice is to do this only after after investors come in. The one exception would be where you have very senior, what you call the founding group. The key management people outside the founders. They are not comfortable if you don't have a proper pool in place. But even there, what has often worked is a simple letter, what we call a pre-planned letter, which simply says that we are in the process of creating an ESOP plan, and once we have created the plan, so many options will be allocated to you. Make sure that the necessary legalese is there in that letter, and that works for people. As far as creating a pool is concerned, there are two parts to creating a pool. One is in your own minds and in your founder agreement cap table saying that there's a pool of so much. The other thing is actually going and creating an ESOP plan itself. What we would recommend is create the pool in the agreement so that you know how much is being allocated to the team. But actual plan you can postpone to a point when it is necessary. See, the problem of doing a plan too early is it looks, the value that is getting allocated in grants looks very, very small. and therefore, becomes meaningless. You end up giving more because of that. After the value gets established, it's easier to make grants. So create the pool, have an understanding of what the pool is, but actual grants, don't do it till the investment comes through.
That's helpful. I think we have a couple more questions. We have Pramod asking if founders transfer equity to each other, is the transaction taxable?
Definitely, it would be. There is under the new tax code, under the new tax provisions, when you transfer shares to a person who's not your immediate family member, that gift is taxable at fair value being the book value.
Sure. I see a couple of new questions as well. I think we have a few minutes, so we could just take them as well. Kaushik wants to know, does an investor generally ask for non-dilutable shares? If yes, is that fair from a long-term standpoint, especially for future investors?
Investors normally don't ask for non-dilutable shares. If they do, you should just say no, because non-dilutable shares are extremely dangerous, can be used only in extremely rare situations. In my 17, 18, 19-year career, I've probably seen non-dilutable shares a couple of times.
Okay, this is insightful, yeah. Vijay wants to know where to hold the shares of co-founders when we have the 4 years vesting and 1 year cliff, if not with one founder.
So the most common practice in India is to just leave it as equity shares with an agreement that you will transfer the shares out at a later point of time. If there is, if some of the shares don't vest, the cleaner way of doing it possibly is to have founders also own preference shares, where the conversion ratio can be adjusted linked to employment. We've discussed that a few times with the tax teams, but not got a clear and cogent answer, and therefore it is not a very common practice today. But these are questions that we are figuring out at Rule Zero and getting clarity on it. And once we have clarity, we will post it on our website on how we want to deal with that.
Sure. We'll have more. So I see Hema has this question. What the first-time entrepreneur needs to know about exit policy? What is the best exit policy? Is it IPO or private equity?
See, it's really what you want to do. A lot of founders don't like to IPO companies because, IPO means you get tied in on the long term and, it's quarter-on-quarter performance. A lot of founders don't like that. There are a few founders who like it. So it really comes down to personal choice and depends on, how scalable your business is, how large it is, how profitable it is. A lot of companies tend to get built for just exit in the form of an M&A, sale to a strategic player or a private equity investor. But it's really personal choice.
Sure. And there's one question which a lot of founders keep asking. What are the do's and don'ts for advisor equity? What is a typical percentage that you may have seen?
Depends on the seniority of the advisor, anywhere from 1% to 2%. But founder advisor equity needs to vest like any other equity. Unfortunately, in India, you cannot give advisors equity under ESOP plans. So you end up doing it under, phantom plans or stock appreciation right plans. Make sure that it's subject to vesting, typical 3-4 year vesting. Advisor relationships don't often work out because of time commitments. So don't allow anything to vest quickly unless it's somebody you have super confidence in and you have super confidence that the relationship will work out. Right? It should be subject to standard vesting.
Right. And the next question from Aditi is, post the 4-year vesting, if we get a new investor, do they again vest founder shares?
Often that happens. New investors ask for founder vesting, that the revesting of the founder stock. At a Series A level, it's rarely 100%. Anything from 40 to 60, 70% will be subject to vesting, subject to revesting. It's fairly common. Like I said, it depends on the maturity of the company at that stage. It's not a bad thing, especially with young entrepreneurs, especially with entrepreneurs where you have 3-4 founders in a company. Those are situations where you see founders leaving, founders not getting along, and then you're stuck with a situation where a founder is holding a significant amount of stock, lots of brain damage in sorting issues out, buying those shares out, what value you pay, etc., etc. So founder vesting is not a bad thing. It should just be commensurate with the stage at which the company is, the level of maturity of the company, the maturity of the founders, when you think exit will happen. So make sure that you think through it, but it's not abhorrent, it's not bad.
Great. I think the rest of the questions we would email it to you, and I think we should have more learning and development sessions with you. Thank you so much for your time.
No problem, Vijeta. Thank you.
Yeah. And we'll have our next guest. Vijeta, would you like to welcome?
Thank you, Srinivas. By the way, that was Vinay who was doing everything. And but thank you for this, Srinivas. We need to get you on I think there's going to be one more session that we have to do, many more sessions with you, but that's for later. Take care. And now, Ragini, ma'am, pleasure and delight to have you with us.
Sorry, Vijeta, my apologies, Vinay.
No, relax. No worries on that front. Okay. He did a great job with the moderation. And now, Ragini,
Srinivas, that was a great session. Thank you. I found it.
Ragini, thank you.
Thanks, Vijeta. Thanks, Srinivas. It was a great session. Very useful. Yeah. So, thanks, Vijeta, Vinay, for having me here. Thank you all the participants for taking out time. I'm going to delve on two topics today. Basically, what is impact investing and how debt financing can be part of your financing strategy. So, all the things that Srinivas told about in terms of readiness for it would apply to any kind of funding, including debt. But we'll get more into that as we get into. So I'll just share my screen and just give me a second.
Yeah.
No, not this one. Just not give me a second.
Sure, Agni. No rush.
Yeah. When you're multitasking, this is what happens. Just 1 second. Yeah.
No problem. So just to tell the audience that this is going to be of the presentation, but you can please ask questions to Ragini also. Okay, put it on the chat. Don't forget.
Yeah. Great. So we are good now. I'm just going to take a minute to. Only problem is when you're presenting, you can't see. Yeah.
We'll tell you, Ragini. Don't worry.
Okay.
Vinay and me are there, so don't worry.
Okay. Okay. Sure. So are you able to see this?
Yes. Go on full screen mode if possible.
Yeah. I'm going to do that in a minute. Yeah. It's not allowed. Okay. Done.
Yeah.
Great.
Okay. Thank you.
Yeah. So. Hi everybody, I represent Caspian Debt. It is a company promoted by NBFC, a company promoted by Caspian Advisors. We are a certified B Corp. And what we mean by a B Corp is that we are registered by B Labs as one of the 3,000 companies who is sort of making profit and purpose go together. And more about this as I talk about them. We are one of the only impact investors in India to be a certified B Corp. So I'm going to talk a little bit about impact investing and debt financing, and I hope to keep it short so that we get time to go into questions. Just a little bit about Caspian. We were first investor across 3 sectors: urban microfinance, affordable financing, and affordable housing finance. And we've done both debt and equity through 4 of our funds: Bellwether, IFIF, SME Impact, and Caspian Debt. I represent Caspian Debt. We have an upcoming fund on food and agri startup. And while we started with financial inclusion, we now cover several sectors that are considered very high impact, like food and agri, clean energy, and such other. These are some of our investments. So you would know Ujjivan, Janalakshmi, Equitas. They all went on to become small finance banks, and these are some of our debt investments. Yeah. So just to tell you a little bit about what impact investing means. Sorry, just 1 minute. I'm getting a lot of background noise. 1 second. Yeah. So what impact investing actually means, differentiates from other investors is the intention bit, the intention to generate positive impact, which is measurable. But this not in isolation, but along with the financial return. Okay? And you will find these investors where there are world's most pressing challenges like agri, renewable energy, and conservation, and financial inclusion, basic services, water, sanitation, education, healthcare. And hence impact investing, there is no surprise that India is a very large hub for impact investors, because we have all these basic issues to be still solved. So the key differentiator for any impact investment is, one, there is an intention, not only to generate the impact, but also measure it, that is one. So you will see that as a point number 5, they do impact investment. They have a range of financial returns. So starting from below market return to market returns, and impact investors usually look for a scale, because remember they're solving most pressing challenges. So if you're doing something small in a smaller geography, then that is not something that, even though it is very impactful, it may not be of an interest to an investor. And it has a range of instruments. You can do debt, equity, hybrid, different. And of course, you measure impact. All good so far? Yeah. So going forward, so impact investor comes with two worldview. One is that you look at social and environmental impact from a lens that I want to manage it as a risk. So in this category, what happens is you basically work towards avoiding negative impact and you create market returns. So it starts, so there is sort of a continuum. So it's not like, okay, now this becomes impact and this is not impact. It's sort of continuum, which starts with traditional investment, which can they can invest in anything. They have no such conditions on what, as long as it meets their investment thesis, they can do that. Then second comes responsible investment, which comes with sort of an exclusion list. That, okay, we will not do any investment which will lead to a sweat spot or will lead to rehabilitation of communities or things like that. So they can invest in all investment except that exclusion list. And then comes impact investment, which is about they will invest only in specific things. Like we have certain sector focus, which we believe are impactful. And then there is venture philanthropy, which is about they feel that considering social and environment impact is the right thing to do, and they're willing to take below market returns or nil returns for that. So that is venture philanthropy and philanthropy. Impact investment sits in the middle of this. They use it as a risk mitigation strategy. They definitely have an exclusion list, but they also have a focus on creating more impact, right? So some of the characteristics are that they take greater risk on investments, and they come in at a very early stage. They take a greater risk when the business models are not very understood, and in spite of high risk, they want to create a financial return. But these investments take much longer time: patience, expertise, collaboration. And they do three things: they intend impact, they contribute to impact by making investments do report, measure, and they also sort of measure it. So it's not that they don't work with commercial investor, or commercial investors won't be interested in companies. Actually, they come in and de-risk the commercial investors so that they can come in with a bigger capital. So to give you examples, like Ujjivan, you would have heard of Ujjivan Small Finance Bank. It started as an MFI, where in 2005 we did a seed funding, and then other impact investors came in, and then more private capital came in until it went to an IPO in 2016. So there were Caspian, then other impact investors which sort of de-risked, and then larger investments came in, so that's how it happens. Similarly, for another company called Stella Apps, there was a seed investment by Omnivore. We came in as with debt. Again, a lot of private investors, the commercial investors came in like Bloom, and eventually they also got debt from Stride, and we continue to lend to them. So basically, we come in earlier in an untested business models. So status of India, like I said, most basic problems have to be still solved. We are a large hub for impact investments. We have around 10.8 billion invested in over 500 companies. And over time, the focus of investment has shifted. Earlier, it was largely financial institutions. Now it has become multi-sector, like Caspian has become multi-sector over time, agri, health, education, and not. We started from financial inclusion and moved to this, right? Now I would talk about debt and startup financing, and I can take questions of both of them towards the end of the session. Yeah. So, just imagine that your business, suppose your business is about, you want to start a business which is about a car running which collects a lot of data, and that data is useful to a customer. So you want to buy that car, start with an equipment, and you are sure that this data will be valued by the customer. So you go out looking for funding, and you realize that you don't have a credit history, so you may not even get a car loan. So you rope in your friends, families, and what you say pools. They give you some money, and you start off with this car. And early results are very promising. So you are able to see your traction and get an angel investor. As soon as the angel investor comes, he says that I will invest, but I would also want the front seat in the car. So you said, okay, I need the money. You take the front seat in the car. Then using this money, you are able to get a better data quality equipment. You start to, build more traction in customers. You're spending on, marketing. You start to get customers, but you realize, and then you have some running costs like petrol and diesel and digital marketing and all that. But you realize that you're not making enough revenue. So you go out, you meet your angel investor, gets you another set of investors, and you end up giving one more back seat of your car. So you go on, and suddenly you realize that you are at a juncture. Your customers are paying, but they're paying you a month late because they want to know whether the data is working for them or not. Petrol costs you have to pay every day. The revenues, that's why the cash revenues you are generating, but cash flow is not enough to cover your costs. Now you are at a juncture. Do I go raise another round of equity and give the last seat that I have remaining in the car, or should I take debt for using my running expenses and take equity to buy another car and buy another equipment? And these are the choices which a company makes. And using a mix of debt gives you more runway and helps you save precious equity. And what our mission is to help companies scale without dilution, and get them customized debt which meets their working capital and other requirements, and not use precious equity for short-term requirements like working capital, but use that for expanding your businesses, doing capital expenditure, doing research and development, and things like that. So we this is our fund size is around 4.7 billion. We look at companies which have at least 3 years in the business. These are asset light. If any of you go out to take loan from any bank, you will require that. You will know that even under guaranteed government schemes, you will not be able to get a loan without having a mortgage collateral. And many of your businesses like tech and others, you have software, but you don't have building plant and machinery to provide as a collateral, right? So that is where we come in. So these are some of my intake criteria. We look at, so again, here it is important that debt comes to a company when they are revenue making, they have cash flows, because debt is different from equity. You have to return it back, even though it is less expensive, non-dilutive, but remember it puts a pressure on your cash flows. So we look at some of these things like revenue, where is it coming from? Are you profitable or not? Do you have a cash runway? Whether your leverage is under control, because you can't be, and whether you've been around in business long enough, like 24 months or something. Again, what is important in debt financing is customizing to the need, and that's what we have learned over 7 years, to do it as per sectors. So sometimes we link it to the revenues of the business when you to match your cash flows. Sometimes we make it to match the timing of your cash flows, like education companies get most of their cash flows in March, April, and June. Sometimes for your lumpy working capital requirements, we give you revolving loan, so you draw down, use it, return it back, then it is available again for you to draw down, So we do various such combinations. And from our experience, we have seen, from our portfolio companies, one of our very prominent dairy IoT companies was able to reduce its dilution to 15.2% because we came in at the right time to give them debt, which expanded their cash runway. And then because of that scale, they were able to get a much better valuation, And similar to another company, which is a clean tech manufacturing company, we were able to help them reduce their dilution by 21.7%, So basically, remember one thing, that as you grow in different stages, your value of your company and your equity, if you're on the right track, increases. So every investment you take in equity terms is reducing your share in that pie, So, so that is where a combination of a debt and equity helps you get a right balance. And even a better valuation for your company, as I told you from my last two examples. So, but there are times when you should not borrow. Equity is the right capital. Again, if you don't have a paying customer, if you don't have proven unit economics, you're still in the MVP stage, or you're still figuring out your product market fit, then debt is not an option for you. Your revenues, your customers are paying for you, your existing cash flows are great, then you don't need to borrow, right? And if you've reached a point of a very low cash runway, again, debt is not a right option because it will put additional pressure on your cash runway. If you already have borrowed a lot, then and your capital adequacy is lower, that's also not the time to borrow. And if your revenues are not able to pay for your loan, and only fundraise is an option to repay the loan, that is also the time not to borrow. So eventually, when you start building your financing strategy, keep in mind the kind of business are you. Are you B2C? Are you B2B? What will be the kind of working capital you will have? Which stage of the business are you in? Are you in early stage? Are you in growth stage? And what are your business plan aspirations of growth? Very linked your whole financing strategy. Again, purpose, match the purpose of funding, with the source of funding. Wasting equity on working capital, especially when you have scaled and you have revenues, is really a criminal waste, because that equity is so valuable. It could be used for research and development, product development, and making more capital investment. And of course, you can make as many strategies as possible. Availability of the right financing and external conditions also make a huge difference. And I cannot emphasize less on the external conditions, that sort of life just happens to us, that kind of a thing. So finally, I do want to say that even though funding is very celebrated, not every business needs funding, and funding is not your success. Eventually, it is about building a profitable, sustainable business is what your key success factor is. So ensure that you get right kind of funding for right purpose. And remember, funding alone cannot solve all your problems. It is just sort of a beginning. And again, don't be too fixated on whether it is pre-series A, series B. The stages and type of investors always keep blurring, based on market outlook. Even the bigger check, people go into smaller checks when the situation is difficult out there, when they don't have enough conviction with the market. And you may have to make a lot of trade-offs along the way. Sometimes the valuation may be low, but the type of investor for your sector might be great. So always look at what else an investor can bring to the table, So valuation is not the only thing. The external conditions will make a difference, Again, amount versus conditions, Sometimes the amount would be good, but the condition may be very difficult. Like they might revest your shares, or they might do anything, Sometimes, speed versus, it might be very cheap to get funding from some places like public sector banks, but they might take 6 months to give you that loan or give you that funding. So, all these trade-offs you will have to make along the way. And of course, the next session sort of weaves in very well. Always read the fine print of term sheet. So do listen to the session of the next session very, very, carefully. Shri is a great, he has an amazing experience in both impact investing and negotiating term sheets to get his tips. And don't rest on your laurels, manage your cash runway. If COVID has taught us anything, it is about making your cash run longer. So be frugal, manage it well. And I think this Srinivas also spoke about how your finances, even though in Excel, should be managed and reported properly. So that's it from my side. Happy to take questions.
So a lot of new learnings for all of us.
Sorry if I was faster, but I hope to cover up now.
Yeah.
Yes.
Especially the the quote, match the purpose of funding with the source of funding. That's something. So there were a few questions. One of the question was, how do you evaluate startups? I saw that you had a slide earlier. The same questioner had one more question. Could you sort of light on the structuring of debt funding, especially in the context of impact investment? Like, do you look for a fixed EMI payment, convertibles, or any other form of repayment, especially considering there's no predictability of cash flows at early stages?
Yeah. One is what we look at is key basic pillars for our evaluation. One is governance. So all that Srinivas talked about, in terms of having the right compliance, records, registrations, board, the founder contracts, your own internal audit, and also your external audit, compliance, all that governance comes very key. And I think for us, that has turned out to be a critical success factor in whenever we see how our investments have performed on debt, The second is the management. How strong people, do they know how to run the business, what their management depth is, second line, HR practices. We are very keen on evaluating all your HR practices, gender desegregation of data and all that. And third is the financials. So you can't be your revenues, whether they're coming from one source, how much of it is coming from government, predictability of revenues, your gross profits, EBITDA, capital adequacy, all that. And in terms of structuring the debt, we provide unsecured loans, no mortgage collateral is required. We customize it to the nature of your cash flows. So it can be EMI, it can be quarterly EMI, it can be, we can give you moratoriums, we also do small convertibles, any depending on how your cash flows are. Yeah.
Yeah, I think this answers Suresh's question: is it secure or unsecured? This is unsecured finance. And we have another question from Kaushik. Does it make sense for impact investors to invest in new product startups with existing models, not necessarily new business models as you outlined?
Yeah, absolutely. It can be existing new, but the only thing about debt financing is that it should come at a stage when you are post-revenue. You should not take debt in a pre-revenue stage unless you have a lot of equity to cover the ground. If you have a lot of equity and you want to save it, then you can take debt. But usually, very early stage, the debt is not advisable. So it is more about your stage and your business model strength. It doesn't matter whether it is an existing business model or a new business model. That doesn't matter.
Yeah. We have a question that says, I think it's an entrepreneurial question. How does one break into this impact investing industry venture?
I think you should be following the pages of impact investors, in impact investing firms. Look out for all the they are hiring. Look at their hiring. You should connect to the people from the industry one by one step. So I think LinkedIn would be a great place to find out more about. All impact investors have their LinkedIn pages, and there are people from that industry already there. Follow their pages, engage with them, and I think that's how you can, and it is not necessary that people hired have to have an impact background, because yeah.
Yeah, a new question is, what rate of interest is the debt dispersed? Just a ballpark figure.
Yeah, sure. It's all there on our website. I'll put it up. It ranges from 15 to 18%. It is about yeah. So like I said, 15 to 18%. But based on the stage risk factor, because this is risk-based lending, so do have a look at our website. Yes, we do have a restriction on offering debt to partnership firm, because from a governance and compliance standpoint, we prefer to lend only private companies. So my advice would be, for a scale and growth, private companies are better to attract investment, debt or otherwise.
Great. Yeah, so yeah, I see Pranay has a lot of questions, so we should ask him to write to you in detail.
Yes, sure. So Pranay, we've done a lot of innovation in terms of evaluating companies, and exactly our USP is that we are looking at companies who are first generational professional entrepreneurs. They don't have building or mortgage collateral to give. They only have their business and the business model. So we evaluate the strength of the business model and customize a product which works for them. So you are right. That is the gap we are trying to fill. The companies which don't have traditional mortgage collateral assets.
Sure. Let's see. I mean, you've been mentoring a lot of startups in an ongoing manner, so we would invite more of the startups, as in when you have your next few sessions, we'll also invite them. And I see Vijita is also on. Vijita, would you like to share?
We'll do this. I think, Ragini, there are too many questions coming in, but okay. I think we need to organize one more. From Thai, we'll organize. Sure. We'll organize something with you and your team. Okay.
Great.
But,
great.
This was amazing. Okay, this is so much in depth, and you have covered everything. When you should apply, when you should not. I think you did it really wonderfully. Much appreciated. Thank you for this, Ragini. Really nice. Really, really nice.
Thank you. Thank you. Yeah. I just want to say hi to Sri, and then
of course.
Hi, Sri. Please. Have a great session.
I think he'll be coming in.
Yeah. Okay. All right. I think you are all set for the next session. So I'll take your leave, and all the best to everybody.
Sure. Thank you, Ragini. Very kind of you once again.
Bye.
Take care.
Bye.
Vinay, we can help set up the next one.
Yeah, so he's.
I think you just have to unmute.
Yeah.
Shri Krishna.
Yeah. So in the meantime, we would request the attendees to click on the link that is being shared and to give their feedback inputs, because the government folks would like to get your inputs They might even call you, so your number is also important, right? So please feel free to share your inputs. Let me just request Sri to unmute.
Because we are working with the Karnataka Digital Economy Mission, KDEM, and with the KTech and Karnataka Startup Cell to set all these interactions and activities for the entrepreneurs and founders. So please, please, please make sure that you fill in the forms. Okay. Vinay, are we having any challenge with Sri Krishna coming on?
Yeah, so he said he was here, but oh, somehow, okay, let's just make him the co-host. 1 second.
Yeah. But thank you to the wonderful participants who are making it very immersive. So just keep all your questions ready so that we can, make sure that as many questions can be brought in front of the resource person. Okay. Alrighty. Hi, Shri
All
Krishna.
right. Hi. Are you
Great.
able to see me and hear me?
Yes, absolutely fine. Thank you. Thank you.
No, and also just wanted to do a quick shout out to both Srinivas and Ragini for a great session and just great interactivity from the participants as well. So it's curated up quite nicely. What I thought I would do was not use a presentation, but actually continue with the level of interaction that we've already got and actually allow for more and more questions to come through. But before that, maybe I'll spend not more than a minute or two on just laying out what a term sheet's all about, and then I think we can really jump into questions. So effectively, I'm guessing a lot of us here in the audience have come across a term sheet. I know it usually is a proud moment for entrepreneurs when they've got a term sheet from an investor. I mean, I still remember how it is every time we put a term sheet out to a founder. It's also in many ways a sort of celebration for us as well, because it means that we've come to some level of understanding and agreement that this is a partnership that we really want to build. So at a broad level, a term sheet is really a document that an investor puts out to and shares with the founder in order to come to agreement really on broad terms. So it's been in vogue for quite some time now. It's pretty much been standardized across, I'd say, most of the English-speaking world. A lot of the things that we use in India, I know, are somewhat direct imports from the West and Silicon Valley or the US, which has sort of pioneered this mechanism of private equity and venture capital. You will find that there's a lot of things that investors tend to use the word standardized. But I will say that a lot of things that in the term sheet are negotiable, but some, of course, aren't. The other thing that I've found, we've been investing now here since 2012. We've done a lot of early stage investing. Most often, we are the first investor putting money into a startup. And because of that, we've seen that a lot of times when we're putting out a term sheet, it's usually the first time that a founder is actually faced with a term sheet. And one thing that we've found is helpful is to encourage founders to sort of use the term sheet as an opportunity to sit with their mentor or with a lawyer, chartered accountant, a company secretary, whoever is accessible, to educate oneself about really what this term sheet is all about. And there are things that then you could sort of get clarity around, and ideally sort of drop, be absolutely shameless and ask any questions, even the basic questions, because I've found that the ones that are asking the basic questions are the ones that quickly tend to then wisen up. And fundamentally, what a founder is doing with a term sheet or with an investment is giving up a part of the business. So it's absolutely critical to be sure of what one is getting into, and I think the term sheet sort of sets the context for that. I think the level of sophistication of term sheets again varies from type of investor. Institutional investors have certain special types of rights that they're asking for. Individual investors, perhaps not so much. And fundamentally, this is a precursor to a transaction where someone is parting with their money, and that effectively means that term sheets do tend to be one-sided, favoring the person that is parting with the money. So it comes down to really, having a conversation with the investors, making sure that it's fair on both sides. I mean, some things that we've done, for example, are, once we put the term sheet out, we make sure that we're spending an hour and a half with the founders, just walking them through each of the terms. Of course, like I said, keeping in mind that, it tends to be biased a little bit towards the investor because we're the ones parting with the capital. There's, of course, terms that each of us would have encountered in a term sheet, and maybe I will perhaps share a sample of maybe Unitas's own term sheet, just to give you a broad sense of what the term sheet is all about. I'm guessing, yeah, everyone can see my screen. This is really a fairly standard term sheet. Now there's two, and we've been using this term sheet now since 2012. We've made 30 investments with this term sheet. We have given this out to perhaps, maybe 10 to 15 more such companies where eventually we weren't able to make the investment. So, it's for us, it is fairly standardized, but at the same time, every single time we're making a term sheet, putting a term sheet out, we're always learning something new, and we're open to feedback. These are just standard things that exist in our term sheet. A few terms that get thrown out, liquidation preference is really one such. And fundamentally, what a liquidation preference really calls out is at the end of this. And well, in some ways, I think when we put a term sheet out, half joking but half real, what I say is that this is sort of an agreement to get married, but we've already set the date to separate. Because as an investor, when we're putting money in, we're putting money with a view to exit. So everything that's there in a document that we agree to is about the fact that, hey, yeah, we're all set to get married, but we've also set the date, or the clock is ticking for when this relationship will come to an end. And liquidation preference effectively talks about how much will an investor get, or how much will all the different parties in the in this investment, how much will they get at the time of liquidation. And this means both a great outcome, but also a not so great outcome, and what that means and how the pie gets split. As shareholders in the company, we are entitled to voting rights. We take most institutional investors and most angel investors as well will ask for what's called as preference shares, which means that these are shares in a company that have certain special rights that are associated with them. The other type of shares end up being equity shares, but for purposes of voting, etc., preference shares eventually will need to convert. So this talks about some of that. Two other key things: anti-dilution, where let's say we're putting in money into a company at a certain price. So let's say it's 1 crore rupees and we want 10%, and it's 1 crore rupees and we're taking 10% of the company. So effectively, we're valuing the company at 10 crore. If the next round, for whatever reason, the incoming investor decides to value the company at 5 crore, then it means that there is a dilution that's taking place unfairly towards us. So that's why we ask for this anti-dilution adjustment. And most of these things, again, of course, one other part is as an investor, we want affirmative rights, or we want the ability to vote on certain matters, and our vote, without our vote, the founders aren't going to be able to pass through those things. Again, these are not meant to come in the way of running a business, but more, the lens that we apply really is, we're parting with capital as an investor, and we want to make sure that the capital is getting put to the use, getting put to what it said it would get used for. So things like, for example, item H here, where capital expenditure of a certain threshold. Again, because there are enough stories out there where investor puts in money into a company, and the next thing the company's gone and bought 3 cars for all the people in the team. So things like that are avoidable. So those are some of the reasons why we have affirmative votes. We, of course, from a founder friendliness standpoint, ensure that we're not going to be transferring our shares to a competitor without approval from majority shareholders of the company. Registration rights is really a copy from the Western world, but of course, at the time of IPO, we wouldn't want to be designated as promoter, so that's why this is there. Exit rights, and I'm deliberately going fast because all of this is honestly Google searchable. I just want to give everyone a flavor and then quickly stop to take questions. Exit rights, like I talked about, when we're putting money into the company, there isn't a clock ticking and we want an exit. Tag along really refers to the fact that if any other investor is selling their shares, we do want to be able to tag alongside with them and get an exit. Issuance of new securities, again, in follow-on rounds, we want to be able to invest and maintain our shareholding. This also refers to as pro rata rights sometimes. So let's say we own 100 shares in a company. We want to be able to, in the next round, put in capital into the company at that valuation of the next round, such that we have the ability to maintain our shareholding and get an additional 100 shares, etc. Right of first refusal, again, this is commonly known as ROFR. If any other investor is looking to sell, we would like to have the first right to be able to buy those shares. And again, I think Srini Katta talked about management lock-in and promoter vesting. Again, fundamentally, when we're investing in a company, we're betting on the founders and the vision of the founding team, and we would want them to stay invested and stay in the company for at least 5 years or so, because again, this is for us 5 years because we are an early stage investor. So that's really what this details out. We talk about little about ESOP, talk a little about board observer, the fact that we want to be able to have access to information, and we want to be able to so that's really what the information rights talk about, because all of this again comes from the fact that we're only a co-passenger in this, going back to Ragini's analogy on the car. Fundamentally it's the founders that are in the driver's seat, and we don't have day-to-day visibility as close to the ground as what founders have, and hence some of these rights that we ask for come from there. And then of course there's certain legal aspects to legal and compliance aspects that the founders need to do before the round closes. As an impact investor, and actually as any investor, I think we want to be able to we invest, and we have an approach called a profit and values approach, which fundamentally we're also making sure that founders and us are signing up in this together, and upholding integrity and a set of values that that we work together on. So that's really something that we put in. Again, fees and expenses, these things vary as well. Sometimes investor pays for it, sometimes the company pays for it. It could be either depending on the size of investment, etc. Of course, non-compete, non-solicitation, again, going back to my previous point, we're fundamentally betting on the founders, so we don't want founders leaving. If there's IP, then that going somewhere else, because a lot of this has been built with the capital that the investor is parting with. Again, some other rights around the ability to change the auditor if that's required. Again, one sees situations where you find that one discovers later that the auditor turns out to be actually a relative of the founder, etc. So all of this is really to avoid for those kind of situations. Fundamentally, investors and founders operate in an environment of trust, and that's just paramount to any situation and any dealing. But a document like this really helps prepare for an unforeseen situation where things don't go well and don't go in the way that one thought it would. I think that's really what this is protecting against. Confidentiality and exclusivity actually survives a term sheet. So if for whatever reason, one signs a term sheet with an investor, but the deal doesn't go through, but it's important to ensure that confidentiality and exclusivity does survive, because that's just paramount. And again, going back to the fact that we're all in the business of trust. So that's, I think, broadly. I'll stop with this on really sharing, but I thought it'd be helpful to put out what are the key things in a term sheet, and some of this is searchable online as well. So anti-dilution, we talked about, right of first refusal, right of first offer, I think a few things to, I guess, think through. The level of detail in a term sheet will vary from investor to investor. We've seen situations where, I mean, ours is, for example, an 8 to 9 page term sheet. And we like to arrive at agreement on all of the details up front, so that then it becomes easier to get into the shareholders agreement and move on from there. Whereas another school of thought is just put out a very simple term sheet with just the basic things in place, 1 page at the most, sign off, and then you can have the rest of the negotiation later. No sort of right or wrong. It's just an approach that different people tend to take. We prefer to take the approach of agreeing to everything upfront because it saves a lot of time, effort, and hassle later on, because you've agreed on everything, you've signed off, right? And then it's really, getting into the agreement and closing things out from there on. But it again, and it varies also from institutional investor to individual investor. I think that's also the other thing that I would probably put. Of course, there's also the other sort of critical piece. You would have seen this at the start of the term sheet itself on term sheets being binding versus non-binding. Most term sheets are actually non-binding, which means that you may have, as founders, you may have signed the term sheet, or as investors, we may have signed the term sheet, but it's not legally enforceable. And unless and until the shareholders agreement and the share subscription agreement is actually signed. And very few times are actually people signing binding term sheets. If it's a binding term sheet, it means that it would have to have a lot of detail and a fair bit of agreement already in place before that could get executed. I think this is a little more in the legal realm. So that's on. So those are, I think, I'd say the highlights. Maybe we can jump into a few questions, and I see a few that have come here. Any notes on? I'll start with a question from Jagat. Any notes on differential voting rights and acceptability in Indian context? Still early, Jagat. I know there is a fair bit of, and this is lesser at earlier stages, but more, I'd say, at later stages where founders are putting in place voting rights and a class of shares for themselves that enable some of this. I think what's driving it is as additional rounds of capital get raised, founder holding comes down quite a bit, and that's sort of leading to some of this. I think it's great to be able to enable this, but still early. I don't see challenges with acceptability with Indian VCs. I think because of most Indian VCs have a strong level of understanding of local context and know where some of this is coming from. So unlikely that there will be challenges on that front. Difference between, there's a question of Anu on difference between safe and convertible notes. I'll give you a very sort of a lay response. Safes are a newer instrument and very straightforward and simple, as the name itself says, right? Safe expands into simple agreement for future equity. A convertible note is more of a I think as an instrument has been around for more longer, particularly in India, and hence perhaps more you'd see investors leaning more towards putting a convertible note than a safe. From a legal and a sort of that from a legal perspective, I don't have a full answer on the difference between the two. I know, for example, when we've looked at the safe notes outside of India, it's not been something that we've been really comfortable with. We prefer to do either a convertible note or a convertible preference share type of agreement. We don't do safe agreements at this point in time. There's a question from Pranay from a viewpoint of a startup. Should I consult lawyers before to float a term sheet and costs are prohibitive? Is a term sheet a good to have or a must have? Great question. There's a few sort of questions in that. If the term sheet is coming from an investor, and it could be either an angel investor or an individual investor, it would help to get a perspective and feedback from a professional. And when I say professional, this could either be a lawyer or a chartered accountant or a company secretary, and someone who is each of these, any of these, who have some level of experience in having dealt with term sheets. That would be my view. And for example, I think very early on, a clause that we put in our term sheets also is that at the end, we get the founders to acknowledge that they have sought a view on this before signing off, because it is, fundamentally, there is legalese, and it is a legal document, binding, non-binding aside, and it's a document that one is signing on, and you can't say that, yeah, I just signed off on this, I read it, but I didn't get the full import of it, right? And on some of these things, it just helps to have professional help. And there again, while it's easy to fall back on Google and YouTube, it really is important and critical to make sure that one is getting help from professionals. So that's one part of the question. We've not seen too many situations where the founder is floating a term sheet. And so if you are in that situation, and I mean, honestly, I think that's a advantageous situation. Definitely, please consult a professional before you put a term sheet out. And I think lawyer costs are prohibitive. I don't fully agree. I think there are, it's about finding the right kind of legal team to help with this. I think most of the legal folks and even company secretaries and chartered accountants that help with early stage founders completely understand what it means to be doing it with early stage founders, and hence, cost is not something that comes in the way. And please also think of it as an investment, because you're educating yourself, one, and you're also, like I said at the start, when you're parting with a chunk of your company for this, I think it really is an investment and not a cost. There's a question from Mohammed Abdul Aziz. Once we have a term sheet, should the share allocation get updated, etc.? No, answer is no. You update all of that only after you sign the full shareholders agreement and the share subscription agreement, and only then do that, where there's a process involved. A company secretary will really be able to help with that in terms of filing pass forms, etc., with the MCA and going through that entire process. Cap table platform similar to US and India. I'm guessing Rule Zero sort of helps with that. If you heard Srinivas Kata talk about what they're doing, it is starting to pick up. So there are a few platforms like Rule Zero in India that are doing this. I have a question, and maybe I'll ask of the group here. Have any of you encountered a term sheet, and what have been your reactions or responses to that? And if maybe we can do a show of hand if we have a few minutes, and enable folks to share their views as well, because I think that will collectively be will be actually helpful for the group as such, because I caveated when I started that the views we put out are biased towards the investor side of things. Would be great to hear from founders as well.
Yeah, so all of you are unmuted now, so you could feel free to share your thoughts or even raise your hand or comment.
Yeah, and please don't all of you jump at the same time. No, I'm just kidding.
Hey, Sri Krishna, Ajay here.
Yes, hi.
I have a question on participating preferred stock. We have put together term sheet in the past. My company is really a Delaware C Corp, and for our first round, we put together the term sheet, and the investor has signed it. That time it did not come up, but this time, we are trying to get. We are going for the seed round, and we're doing a convertible note. And this participating preferred stock came up. So what's your opinion on participating preferred stock? My personal opinion is stay away from it, but I really wanted to hear from your side.
Don't know enough, and won't want to comment where I don't know. So yeah, I'll really leave it at that. Because again, we've not seen this in the Indian context at all. A standard sort of standard instruments that we end up using are either a convertible note or compulsorily convertible preference shares, and those are essentially shares, but with the special rights that are associated with it. So I'll leave it at that, Ajay. Sorry.
Okay, no problem. Actually, I put in a question here. I guess you did not really see it. I just wanted to know whether Unitas as a firm invest in enterprise SaaS companies.
Sure.
I know you have kind of like, you have your preference, in terms of, where you invest and what kind of companies you invest. But I just want to know.
I'll quickly answer that. I think I missed that question. Enterprise SaaS, I mean, we have invested in enterprise SaaS. So our sector focus is really job tech and fintech. And in those sectors, we have invested in SaaS. So for example, an enterprise SaaS company, we have invested in this company called i3 Systems, which is in the insurance space. They enable insurance claims automation for insurance companies in healthcare and other sectors. And they are a SaaS provider to insurance companies and TPS. And on your other question, our preference is a priced equity round. So usually for the amount of money that we're investing in, we'd like to be owning somewhere in the 18 to 20% of a company. We know we'll get diluted in subsequent rounds post that. So that's really how we operate. With earlier stage and smaller ticket sizes, we have done convertible notes as well. But our preference is price round. We're okay to do, we have done some pre-revenue, but ideally, we prefer to come into companies where there's some bit of revenue, ideally, reasonable amount of growth that's taken place.
Okay, great. Thank you.
Thank you.
Hi, so this is Kanchan here. Good evening, Sri Krishna sir. Thank you so much for the wonderful session on term sheets.
Sure,
So my startup is Loan Genie, and we're giving small personal unsecured loans to salaried millennials in Bangalore. So basically a fintech into lending, and we are a for-profit with purpose. So we aim to donate some 5% of our fees to Akshay Patra.
Sure.
So looking at,
if you're looking to get feedback on the startup, could you please connect on LinkedIn? I'd like to keep the conversation more towards the term sheet because that's what we're talking about.
Right. Sure. Absolutely. I'll do that. Thank you so much. And so my question was that, post-COVID, has there been any changes in the structure of the term sheet? Are there any clauses that people would like to focus more on, given the unforeseen situation?
What you're asking is, are we asking in the term sheet if founders are vaccinated or something like that? No, answer is no. We've not seen any changes. We've not done any changes to our term sheet. It's a good question, though. I mean, whether investors are applying a COVID lens in the documentation, we've not. I haven't seen it, but it might happen. I mean, it's a great question. Sure, because you do have force majeure or whatever it is called legally, that people have started paying attention to, at least in contracts. So This is why I was wondering if there's any change. So thank you, sir. We haven't seen. And the only thing I guess where it's being used is for founders and even for ourselves to negotiate rent with our landlords. But it hasn't happened with founders and investors yet, the force majeure. So thankful. Right. Thank you, sir.
So hi, this is Pranay. Going back to your question on certain things, Justin, like some perspective on the term sheet, right? So I work with Head Start as a volunteer, a fellow, and we were mentoring one of our startups who was raising a fund, and I just thought I'd share this since you asked about the term sheet. So he was evaluating the term sheet, we looked at the term sheet, and what we noticed is that, like you mentioned, that you have conversations with the startups like for an hour or two, where you take them through and you explain to them why each clause is the way it is. Yeah. I don't think that had happened over there. So it was, like you said, it was super investor friendly for sure. But of course, there were certain things that could have been negotiated better. So I think the session that you've taken today is something which would really help startup founders go into details of terms. Like for example, like a minimum IRR, right? And that if you don't achieve an IRR, then let's say it's an event of default. So then that becomes really prohibitory.
Yeah.
So I think.
So I mean, I think I didn't talk about some of these. There are, I guess, for lack of a better word, poison pills that do come into term sheets and into these agreements. It varies really from investor to investor, and some of this could get viewed as sort of not being as friendly. So, for example, we don't have a drag along clause in our term sheets because we just think it's unfair for a reason that could just be more individual to a particular investor. Doesn't mean that you the drag along gets enforced and then everyone is penalized unfairly, and the founder as well. It could actually be unfair to the founder. So that's something that we've not put in. We don't actually set a time for exit because we understand with early stage investing, it's hard to predict whether you'll be able to give an exit in 5 years or 7 years. So we've just kept it that the founders and the investor will work together to get an exit in a reasonable manner. So some of those things, Pranay, actually do exist, and maybe one way to have a conversation like this, and more than happy to work with Ty on this. It would be helpful to do this as a conversation with someone that's experienced on the legal side and an investor, because I think doing this in sort of only investor or only a lawyer could be hard. But that's helpful feedback, Pranay. So I'll make sure that we're, of course, request Vijay.
Thanks so much, sir. This was super helpful. Thank you.
If there aren't any other questions, I mean, I have to jump off onto another call. I'm sorry, but feel free to reach out on LinkedIn or to us on our website if you've got more questions. Always happy to answer those. And I think Ty is a great platform for this. And going by the response, and there's close to 100 people here. I'm guessing it's useful for most of us. We could easily do a follow-on in the manner that follow-on conversation. In the manner I talked about, for where I think more folks will benefit.
Definitely, Shri. I know you said that you have a 5:30 hard stop, so please, feel free to step out. But much gratitude. You have been phenomenal. Thank you so much.
You're very kind, Vijay. Most happy to. I think it's really all Thai Bangalore that's doing all of this for the ecosystem and the entrepreneur. So most happy to help in any way I can.
Thank you. Thank you so much, Shri. And you take care, okay? Thank you for this. We'll stay in touch. Bye-bye.
And thanks to all the participants as well for the enthusiastic participation and the questions, most importantly. Thanks.
Absolutely. Absolutely. Take care. So for everyone, just a few things, okay? Some housekeeping thing that we also have a session on the 10th of July, which is a workshop. Would request all of you all to please, we have put it on the chat, log in, get in there. We have obviously, it's there on all the WhatsApp groups, it's there on our website as well. That also is going to have some phenomenal resources. So please, and we will make sure that it's going to be interactive. All right. So that's number one. Number two is we have our emotional wellness and mental well-being session now at 6 o'clock. So we have 7 more minutes. So Vinay and Adya, Pratiksha, who are part of our team, we need to get as many responses as possible, folks, because the government of Karnataka has requested us. They want to also interact with you. Right? They want to understand what they can do better for startups. So there is a form that is there that I want every single one of you to please. We have only got 30 responses, and considering the fact there were about 100 plus people out here. So we need you all to fill up this form. It's for your own good, so that the government of Karnataka can reach out to you guys, help you guys with some of your questions, queries. There's a lot of things, a lot of programs that are being run by the Karnataka Digital Economy Mission, by KTEC, by Karnataka Startup Cell, of course, at TAI itself. So we need you to fill up this form, okay? And you all can come in on video. We have opened it up. Vinay is also here from our team. Is there something